Okay, hi everyone. This is going to be the lecture for chapter 1. We're going to be talking about financial statements and business decisions. So we have about 22 slides in this presentation. I'm going to try to do an overview here, give you some insight as to the nature of this course and what we're going to be learning about. So in this chapter, we're going to be talking about the accounting system, financial statements, the accounting communication process, and then ethics. So normally every week in how I teach this class is that first we go over the materials in the PowerPoint. That kind of lays the framework, as it were, for what we're going to be learning about in the week. Thereafter, the second class session, right after we kind of learn the fundamentals, we're going to be doing some problems, right, that show how what we learn in the PowerPoint is done. Now, the one thing I'll say about accounting, accounting is really learned through doing. That is to say, you're not going to be able to just read the PowerPoints and succeed in this class. In other words, you're going to have to put in the time, do the problems, look potentially at the optional problems, look at the homework. It's one of those things where it kind of all comes together at the end. So this is not the type of class where you can just read the PowerPoint the night before and you'll succeed. It's really a time dedicated class where you have to put in the effort. So when we talk about financial accounting, right, we're talking about financial statements. And we're talking about, in this case, what we care about are external users of a business. That is to say, things like investors, lenders, and creditors. So, for example, imagine that we were on the show Shark Tank, right? And we were attempting to sell that Scrub Daddy product. So if you don't know what Scrub Daddy is, it's like a little sponge that has like a smiley face on it, and you can use it to get into hard to reach areas. So we have this really good idea. We're growing. We need access to capital, like money, to grow the business. Maybe we have identified a new market or product that if we had more money, we could go after and grow and get bigger. So how we get more money is we would go to like investors, right? The sharks. So if you ever have watched Shark Tank, essentially the setup of it, the first 5 minutes is kind of like a pitch. It's like an as seen on TV commercial. But shortly thereafter, right, once the actual product is discussed, then they start getting into the financial information about it. So the sharks may say something like, "Can you please tell us what your sales were? Can you please tell us what your net income was? Do you have any debt? Right? Are there any other shareholders?" So the idea with financial statements is kind of like that. That is to say, we're producing for financial statements, we'll talk about them, that are meant to be used by external individuals from the business. So like sharks, right, on Shark Tank. Now, not everybody's going to go on Shark Tank, right? Normally, what we mean here is a company that's looking for just stockholders, right? And in this class, traditionally what we're going to be looking at is like large multinational corporations. So we'll see things like Apple, Nike, Amazon. They do have to produce financial statements, right? Because they're publicly traded. A lot of investors who are going to want to buy their stock on the stock exchange, they need to see that information. However, smaller corporations and smaller businesses also produce financial statements. So maybe you have like a local construction company and they are growing bigger, right? And they go to a bank and they say, "Hey, Mr. Monopoly, can you please lend us money?" Well, the bank is not going to just take their word for it. The bank's going to say, "Hey, we want to see some financial statements that are also audited by a CPA." So it does run the gamut from small to big business. The idea with this class, right, we're talking about financial accounting, which is meant for external users of the business. We're going to be looking at financial statements. Now, this is in distinction to a separate class called managerial accounting. And managerial accounting is really for internal users of the business. So like managers, let's say like I'm a manager inside a business and I'm looking at like what type of product should we sell, when should we reorder our inventory, what are our sales forecasts. That's like a managerial accounting course. It's a separate type of accounting. And this class doesn't focus on that. That's a separate class, but that's the distinction. Like financial accounting deals with financial statements and external users. Managerial accounting deals with like internal financials, and it deals with internal users. So that's kind of the point of this slide, what we're talking about here. Now, when we're looking at the financial statements, right, there's 4 of them. And for each one, there's kind of an equation that you're going to have to remember with it. Every class, when we go through here, we're going to talk about these equations. It all builds off it. So this is like the starting point, right? We're looking and producing these for external users. What we are producing, the financial statements, there's 4 of them. We have the balance sheet. We have the income statement. We have the statement of stockholders' equity. We have the statement of cash flows. Now, these can be prepared at any point in time, right? So like on the first of the year, the last of the year, any date, we can prepare these, right? Like I can open up and create a balance sheet right now if I want. Likewise, they can apply for like any time span. So the income statement, that may show our revenues and expenses for the last 6 months of operation. So or it could show a month, a quarter, a year, right? It's showing different things. So the first financial statement we're going to be looking at is called the balance sheet. And that's 1 of 4. And why do they call it the balance sheet? Because it balances, right? We'll see the equation with it, namely assets equal liabilities plus stockholders' equity. That's the idea with the balance sheet. Now, the balance sheet is prepared at a point in time. I have here think like a snapshot. It's almost like if you have social media, right? You have like a wall where you make a bunch of posts on it. A single post on a single day would be like a snapshot. It would be like checking your bank account today. What's my balance? Like where do I stand right now at a point in time? This is in distinction with the other 3 financial statements, which are prepared for a period of time. We'll discuss that, but just think point in time, balance sheet. It's like a snapshot. Take a photo. Where are you right then with regard to your assets, your liabilities, your stockholders' equity? Now, on the balance sheet, right, there's going to be some common things you see, like the company name, the title of the financial statement, when it was prepared, what unit of measure they have, like dollars. So if we look here at like a very watered down balance sheet, right? Again, remember I said it's a balance sheet because it balances. 527 equals 527. It's like if you had both of those on a seesaw, right? It would be balancing. 527 on each side, it balances. And specifically why it balances is because our assets equal our liabilities plus our stockholders' equity, right? So, this 527 down here is really just these 2 combined if you added them. So this is kind of like, I call it like baby equations because you have to start somewhere. And I always make the joke, like these little baby equations, it's kind of like if you've ever played Super Mario, you have like baby Mario, and then he gets the mushroom and he becomes like big Mario, right? This class, we're going to start at that like baby Mario level. Like, we're just getting our feet wet. You have to start somewhere. As we progress, right, we're going to expand these things, and it's going to become like big Mario where we really take a deeper dive on it. But that's the idea with the balance sheet. The equation is our assets equal our liabilities plus our stockholders' equity, right? So if you have like 100 of assets, it would equal 75 plus 25 of stockholders' equity. Now, one thing I want to kind of like caution you with accounting that they like to do, they will jumble all of this up. So you may memorize it like this, right? But then they may test you asking for the liabilities or test you asking for stockholders' equity. So what you would do in those situations is you would rearrange the equation to solve for it. Alternatively, things they could do is they could give you like 2 of the 3 items and you have to solve for the missing variable, which would require you to rearrange these. So it's just like simple algebra, solve for x. If they give you 2 of the 3, just plug it in and back out the appropriate number to make it balance. So, we talked about the equation for the balance sheet. What do these items mean, right? What are these elements that are there? So we have assets. These are essentially things the company owns. We have liabilities. These are things the company owes. And then we have this thing called stockholders' equity. And this is a combination of 2 different things. It's really common stock as well as retained earnings. So common stock, or anytime you're talking about stock, what does that mean? Stock is where you basically give up an ownership percentage of the business and somebody becomes a stockholder. Now, it can be like Shark Tank, right, where it's like big percentages, like 10%, 20% of the business, right, you own. But for large publicly traded companies, like if you were to buy Apple stock, you technically own like a part of Apple. You are an owner of Apple. But because there's so much Apple stock, you're like a 0.00001% owner. That's the idea with stock. It's really we're providing equity in our business for money. You become a stockholder, we get that money, we use that money to help grow and run our business. Retained earnings, this is essentially our income that we make in the business that is retained or kept within the business after we declare dividends. So maybe we make like $100 of income during the period, and then we pay $20 of dividends to our stockholders. That means we would have kept $80 in the business. So if you're wondering what is a dividend, right? I wanted to explain a little bit what is stock, what is dividend. So let's talk about dividends. If you're a stockholder, right, the most traditional way people think about making money as a stockholder is through having the investment grow in value. So for example, maybe you buy GameStop stock for $100, right? And then you sell it for $500. In that case, you made $400, right? That's like one way you can make money with stock. That's a very common way. Another benefit of being a stockholder, another way you can make money, is through this thing called dividends. That is to say, the company you own stock of, they may periodically send you a cash payment. Maybe they'll pay you $100 every 4 months, or $1,000 a year. It all depends on the company and how much you own. But it's a second way to make money with stocks. It's basically periodic payments you receive for being an owner of the company. Next, let's talk about the income statement, right? The income statement is prepared over a period of time, or it represents a period of time. What does that mean, right? So our balance sheet here, if we go back, this is like at December 31st. It's like a snapshot. It would be like if you opened up your bank account and you saw that on this day, right then and there, you have like 10.6 of cash. In distinction, an income statement, this is for a period of time. So this would be like looking at your transcripts for the last 2 years, right? We're going to look and see all the A's, the B's, the C's, right? So in this case, right, it says, here's an income statement for the year ended December 31st. So we're going to be looking at all of our revenues, all of our expenses for the entire year, right? It's not just on that day, what did we sell? It's what did we sell and what were our expenses for the entire year. So it's for a period of time. Now, with regard to the income statement, we have two elements, right? We have our revenues and we have our expenses. Revenues essentially are the sale of goods or services to customers. So maybe we sell water bottles, right? We just sold some, hey, there's revenue. Or maybe we provide a service, we paint houses, right? We just painted a house, we got some money, hey, there's some revenue. Expenses are dollar amount of resources that are used to help earn the revenue. It's under this idea of a matching concept. We'll learn later on about the idea of accrual accounting versus cash basis accounting. But one thing here is with your income statement, with the equation, it's going to be your revenues minus your expenses, and it's going to be net income or net loss. What does that mean? So let's say you opened up a lemonade stand, right? You sold $1,000 worth of goods, $1,000, and you had $300 of expenses, right? In that case, you would have net income of 700, 1,000 minus 300. You were profitable. In distinction, let's say you sold $1,000 worth of lemonade, but you paid $1,500 in expenses. You had $1,500 of expenses. In that case, you would be at a net loss of $500, right? So that's like one thing to pay attention to, like when you hear people talk about their business. A lot of times they'll just say, hey, I had $1 million of sales, or my sales were so big. Well, that's great, if you had all those sales, but what were your expenses, right? You could have $1 million in sales, but if you have $3 million in expenses, you're really at a loss. So sometimes the important thing to look at is net income or net loss, not just revenues. But sometimes it's important to look at revenues, like just our sales. It shows the demand for our product. There's different things we're going to analyze, different reasons we would look at components and elements of the financial statements. So this right here is an example of an income statement, right? We have our revenues and our expenses, gets us our net income, right? Generally, expenses are going to say expense after them. You may see something called cost of goods sold or cost of sales. For the time being, this is chapter 1. Just keep in mind that's an expense. We'll talk about those later on. The other thing here to be cognizant of is that it kind of stops right here at income before taxes, and then it backs out your tax expense and gets to your net income. When we do the chapter on the income statement, we'll see a lot of stop signs. I call them stop signs because they're really just subtotals. When you prepare these, right, there's often times where you produce subtotals. But for right now, this is high level. Just think it's your revenues minus your expenses gives you your net income. Cost of goods sold, we'll talk about what that means, or cost of sales. Sometimes we see that's an expense. Just keep that in your mind. The next thing, the third financial statement here, is our statement of stockholders' equity. Now, this has two components to it, right? Remember we said it has a common stock component and a retained earnings component. The common stock component, the equation is your beginning common stock plus stock you issued or sold minus stock you bought back gives you your ending common stock. Likewise, your equation you need to remember for retained earnings, right? Those earnings you keep in business. It's going to be your beginning retained earnings plus your net income, or alternatively, if you were at a net loss, it would be minus your net loss, minus your dividends, gives you your ending retained earnings. One thing I'll mention, and we'll look at in the problems when we do this, if you remember the acronym BASE, B-A-S-E, that's a good way to think about these equations, right? BASE, it's going to be beginning plus additions for the A minus subtractions for the S gives you the ending amount, base. Now that's important for these, right? Because it's like beginning plus you add something minus subtraction equals ending. Beginning plus you add minus ending. It's just the way, many times equations follow that format. And if you think about it, right, what we're really doing here is we're like tracing the flow of what's going on. Imagine you had 100 marbles, right? And then you bought 20 and you sold 10. And I asked you, how much did you have at the end of the day, right? So, I had 100, I bought 20, that takes me up to 120. I sold 10, that takes me down to 110. I have 110 left. That's really what we're doing here, is we're showing kind of the flow of how we get from point A to point B. So this is showing, a statement of stockholders' equity. Sometimes it's called statement of owner's equity. I'll pause for a second just to talk about financial statements, like naming. Oftentimes financial statements mean the same thing, but they have alternative names. For example, the income statement is sometimes called the profit and loss, the P&L, or like the statement of operations. All of that means the same thing, income statement. Like the balance sheet, sometimes that's called like the statement of position or financial position. I just say that because the way we learn these, it's like the most general term for it. But if you do go into practice one day, or you want to be an accountant, they might use a slightly different term. In any event, with regard to the statement of stockholders' equity, we have our common stock and our retained earnings. It looks like here, if we start with retained earnings, we have our beginning plus our additions, our net income, minus our dividends, gives us our ending. One thing in accounting is if you see these little brackets where you see carets, like little carets on the outside, that means a subtraction. Likewise, here for common stock, it looks like we have our beginning, but we didn't sell any more or we didn't buy any back. We just stayed level, right? So it would be like beginning plus 0 minus 0 equals ending. We just stayed the same. The next one here, the statement of cash flows, right? This is basically looking at your cash balance from the beginning of the period to the ending of the period. How did it change? How did you get from point A to point B? And really what we're doing here, the equation for it is going to be your beginning cash plus your cash inflows and minus your cash outflows gives you your ending cash. And anytime you have an inflow or an outflow, you have to categorize it as an operating activity, an investing activity, or a financing activity. So the idea with this is, right, with the statement of cash flows, investors, like I said, sometimes they want to see sales, sometimes they want to see net income, sometimes they just want to see what's going on with the cash. And cash is so important that, we have our own financial statement for it. So again, let's just say you had $500 in your bank account in the beginning of the period, right? And then you had a paycheck put in there of $300 and you spent $100, right? So you have $500 plus $300 takes you up to $800. Then you spent $100, that takes you down to $700, right? That would be your ending balance. Anytime you have an inflow or an outflow, so like an inflow would be cash in plus, in this case it would be the paycheck, right? It flowed into your bank account plus. An outflow is when it flows out of your bank account, a minus. Anytime you have one of those, like plus 300 minus 100, in accounting with the business, you have to categorize that inflow. Was that inflow related to an operating activity, an investing, or a financing? So let's say, for example, we had $500 in there, and then we got $300 from the sale of our goods, right? That would be an inflow related to an operating activity, right? Our sales. Likewise, if we paid our employees, $200, right? That's an outflow. Cash goes out. That would be an operating outflow. Investing activities, so this would be when like the company buys investments or PP&E. PP&E is an accounting term. It means property, plant, and equipment. Likewise, the CF, that means cash flow. I use acronyms a lot in this class because acronyms are used in practice. So you will need to know those. On the exams and stuff, I will spell out all the words, but when I speak and I say PP&E, I'm going to assume that you know that that's property, plant, and equipment. I'll define it. I'm not going to leave you hanging, but you have to be aware of after I define it that I will use the acronym. In any event, right, we're talking about inflows and outflows. Cash inflows from investing activities would be like if we sold a stock. Now, again, this is not our own stock. This is an external stock. In other words, let's imagine we're Amazon, right? And we sold Apple stock for $1,000. In that case, we had cash in, that's an inflow, and that would be an investing activity. In distinction, if we're Amazon and we buy Facebook stock, right, that would be an outflow, right? We spent money on stock, and that would be an investing outflow. Finally, here we have financing activities, inflows and outflows. So this would be like Amazon selling its own stock, right? Amazon stock. So in that case, it would have an inflow. We sold the stock, cash in, right, from our own stock, how we finance or borrow or run for the business. So we will look at these more in depth as we go forward. This is just an introduction video to it. This is chapter 1. So right here, this is showing a statement of cash flows. We have our beginning balance, 1.6, plus 87 minus 125 plus 47 equals 10.6. So at beginning plus our inflows minus our outflows, where we categorize them into the appropriate category, gives us our ending. Next idea here, we're going to be talking about footnotes and some ordering rules. Footnotes are essentially supplemental information for the financial statements. It's kind of like if you've ever read a textbook or an article or a magazine and they have those little asterisks or numbers where you then go to the bottom of the page and it provides more detail, like an explanatory paragraph. Very similar idea with accounting with footnotes. They can talk about what assumptions we made, what rules we're following, how we calculated this given amount. It's kind of like when you look at the financial statements, all you see are the numbers. The footnotes give the details for how we got those numbers. Now, with regard to formatting of financial statements, there's a few things we have to talk about here. Assets on the balance sheet are listed according to liquidity, from most liquid to least liquid. So that's, if you haven't taken accounting, you may not know what liquidity means. Liquidity has a special meaning in accounting. It's not like liquid like water, right? It has a special meaning. What liquidity means in accounting and business, it's basically saying how quickly can you convert this item into cash? So for example, if I gave you 3 items, right? I gave you a $100 bill, I gave you a gold coin, and I gave you a piece of land, right? I said, we're going to play a game. I want you to turn these 3 items into cash, for what they're worth. Ready, set, go, right? You're looking at me and you're like, here's the $100. That's already cash. And then you're looking at the gold and you're looking at the land and you're saying, well, the gold's going to be easy to sell, turn into cash, right? You can go to a pawn shop or something and get the cash for that. The land might be hard. You might have to get a real estate agent. You might have to list it, get a title search. It could take a couple months to sell that. So where we're going with this, liquidity means how quickly can you convert it to cash. If you had those 3 items, you would list them, right, like the cash, the gold, then the land, 1, 2, 3. It's the most liquid, the most easily convertible to cash, to the hardest. to convert to cash, the least liquid. Likewise, liabilities follow a special ordering rule. In other words, when you see financial statements, there's like a rhyme or reason for why they place items on there. It's not just like that they throw things there and then good luck, figure it out. Everything has a purpose. Everything is following a rule. The rule for liabilities is when you list them out on the balance sheet, like 1, 2, 3, 4, you have to list them by their maturity. That is the soonest due to the latest due. So let's talk about, using an example here. Let's say you have a utility bill that's due in 2 days from now. You have a credit card bill. It's due at the end of the month. And then you have your student loans that are due in like 3 years, right? The idea with those, if I asked you, okay, here's the 3 of these, please rank them 1, 2, and 3, which one you have to pay first, second, and third, we would say the utility bill comes first. That's like 2 days from now. Then the credit card bill would come second. That's in like 30 days. And then the third one, the last one we have to pay is our student loans. That's the idea with liabilities, right? We list them 1, 2, 3, 4, 5 based on their maturity. Which ones are due the soonest versus which ones are due later. You can read the other little bullet points down there. It's not that big of a deal right now. The next item here, we're going to talk about the relationship of the financial statements. And we'll see this when we go through the problem for today, for this chapter. So the financial statements are kind of like the pieces of a face, right? You have like your eyes, your ears, your mouth, your nose. Everything all comes together to work as one to like help you interpret reality, right? It's kind of the same way with the financial statements. The income statement feeds into the statement of stockholders' equity, which feeds into the balance sheet. The statement of cash flows feeds into the balance sheet. So it's kind of like a Rubik's Cube, right? If you had a Rubik's Cube and you start twisting and playing with it, all the sides are going to change. It's kind of like a domino effect, right? So if you change like one number up here, it could ripple through and affect these other items as well. So the idea here is you take your net income, the 22, right? That's used here, the 22. Your ending retained earnings, 64, is on the balance sheet. And then your ending cash from the statement of cash flows is your cash on the balance sheet. They're interrelated to each other. This is just the summary chart. It's really saying, what are the 4 financial statements? Why do we care about them? What's the baby equation? And then what are some accounts that you might see on there? One thing I do want to mention when we're talking about the financial statements, this is important. You can see that receivables are an asset on the balance sheet. Payables, in distinction, these are a liability on the balance sheet. What does that mean? So let's imagine that I was selling cupcakes, right? And I come up and I go to the class and I say, all right, here's $100 worth of cupcakes, right? I'm going to give them to you. And then you say, all right, I'm going to pay you 2 weeks from now for that. In that situation, right, I've given you the goods and I expect cash payment later, right? So with that, what we would have in that situation is a receivable. In other words, it would be an asset for me. I could hold up this little piece of paper and say, hey, he or she owes me $100 in 2 weeks from now. That's an asset. That's something I own. I can expect to get this money. Now, from your point of view, the borrower in this case, or the person who's getting and then paying later, you'll have a payable. In other words, you'll have to pay me in 2 weeks that $100. So that will be a liability on your balance sheet. So, receivables are assets, payables are liabilities. Don't confuse them. And what they really deal with are when we have transactions where the cash is paid at a later point in time. Depending on whose point of view you're looking at, the seller or the buyer, each person could have a payable or a receivable. But receivable, payable. And they call it an account receivable because it's kind of like if you were at a hotel and you stayed at a hotel, right? You got room service and you say, just put it on my account, right? The $50 for breakfast. Then when later on, the next day or two later on, when you pay the money, you pay the $50 back. It's because you have like an account with it. Or if you've ever been to a country club or a casino and you're just like, put it on my account, I'll pay it later, right? We'll talk about, in the next chapter and later on, there's also things called notes receivable and notes payable. It's the same concept. It's the idea where cash is paid later. But the difference between an account receivable and a note receivable is whether or not it charges interest and whether it requires a formal written document. Basically, to make a long story short, again, this is getting a little too deep for chapter 1, but I just want to preface it here. Receivables are assets, payables are liabilities. If it's an account receivable or an account payable and you borrow $50, you're going to have to pay back $50 and you'll have to have it on account. If it's a note receivable or a note payable, you borrow $50. When you do that, there's going to be a formal written document that discusses interest that you have to pay. And then when you repay the $50 plus maybe $10 in interest. However it's determined or calculated. That's the difference between the two. So we talked a little bit about like what are the 4 financial statements, right? We have the balance sheet, the income statement, statement of owner's equity, statement of cash flows. Now let's talk about like who makes these rules for accounting. So it's kind of like in the NFL, right? You have the NFL makes the playbook or the rule book, right, for how you play football. In the same way, for accounting in the US, you have this thing called FASB that makes GAAP. In other words, GAAP are the rules of accounting, and you have FASB who makes them, the Financial Accounting and Standards Board. It's like a bunch of accounting nerds who come together to make the rules. If you were to backtrack from this, right, if you were to look like logistically here, you have the Constitution, which creates Congress, which creates the Securities and Exchange Commission. The SEC is basically like a government, board oversight body that makes sure that publicly traded companies are fairly presenting their financial statements and investors aren't getting their money taken from them. The SEC has really delegated the authority for accounting rules to this FASB, right, the Financial Accounting Standards Board, and they make GAAP, generally accepted accounting principles. So what you should care about is who makes the rules for accounting. FASB makes GAAP. It's like the NFL makes the rule book. Now, everywhere else in the world, they use this thing called IFRS, International Financial Reporting Standards, and they have the IASB who makes it. It's kind of like, everywhere else in the world, they use kilometers and meters and the metric system. And then here in the US, we use pounds and ounces. It's a similar setup in accounting. We use US GAAP here, which is made by the FASB. Everybody else in the world uses IFRS, right, which is made by the IASB. Another group, a separate group of like accounting nerds who come together who make these rules. Now, at one point they tried to converge these. Like, it would be efficient if the whole world had one set of standards. That didn't really work out as planned, so that has been put on hold. Last few slides here, going to go through them. Ethics, this looks at right and wrong action. As accountants, obviously, we care about ethics. One thing that was a big scandal in accounting was Enron. So Enron was a company from like the early 2000s. They were producing kind of dubious financial statements that were overstating their profits. And essentially what happened was at a certain point, people figured this out, that they were producing like fraudulent financial statements. And the stock value like way plummeted, and a lot of people lost a lot of money. So post Enron, the federal government, created a lot more rules for accounting, required a lot more regulations and tax laws and auditing laws, and so on and so forth. Essentially, what happened was anytime you have a big publicly traded company, they engage and work with an external CPA accounting firm to conduct an audit of their financial statements. Basically, they use this external CPA, and they say, can you please assess the fairness of these financial statements to make sure they're accurately and fairly presented, that they aren't misleading. Post Enron, what happened is the government said, management, like internal, the CEO, the CFO, you are ultimately responsible for financial statements, not the CPA auditor. Because what happened in Enron, Enron had engaged Arthur Andersen to be their auditor. And when people started to figure out that Enron was fraudulent, the CEO and the CFO, they were kind of waving their finger at Arthur Andersen, saying, they're the ones to blame. They're the auditors. And Arthur Andersen was like waving their finger back at Enron, was saying like, well, we didn't catch, we don't know what we don't know. They weren't giving us all the information. So one thing that came from Enron was management is ultimately responsible for the financial statements. And now if a big company, if a CEO or a CFO signs off, they can get in big trouble, potentially go to jail if there's misleading items in those financial statements. Different types of businesses, you can look at that. Last part here, I'll talk about a few items. If you're going to work in accounting, you really have two choices. You can go in private industry or public accounting. Private industry, where you can go to like government or banking. Private industry is essentially where you're like an accountant internal to a business. So maybe you're like an accountant at Giant Eagle. You're an accountant for Amazon, right? The only person you're working for is one business. In distinction, public accounting is kind of like if you see these law firms on TV where they're like, everybody come in and we'll serve whatever needs you have. Public accounting is like a similar thing. Hey, individuals, businesses, you need tax returns, you need audits done, come to us and we can do that for you. We can provide you these services. So you have multiple clients if you work in public accounting. It's not like you just work for that one company. Now, in public accounting, you have like different levels of firms, like how big the firm is and who they serve. There's this thing called the Big Four right here. So like, for example, I used to work for Deloitte. And then you could have like regional or smaller firms. In public accounting, you would specialize normally. You would work in audit, you would work in tax, you could do consulting, so on and so forth. Now, the one thing that's really important if you're going to study accounting is this idea of the CPA, the Certified Public Accountant. This is like a really big deal in accounting to be a CPA. You have to pass a test, you have to have the right education, you have to have a certain amount of experience. It's really a mark of prestige and professional accolades, right? If you're a CPA. So with accounting, right, there's kind of like three different like tiers almost. There's kind of like bookkeepers, then there's like traditional accountants, then there's like CPAs. It's kind of like with nurses, if you have like licensed nurses, registered nurses, and then like nurse practitioners, like the top type of nurse. It's like a similar setup in accounting. It doesn't mean an accountant is any better or worse than a CPA, like as a person. I'm just saying for like how it's viewed from like a professional standpoint, a CPA is like the hardest to become of the three. So with that, we're going to end this chapter here. Again, what did we do? We talked about the 4 financial statements. We said we have the balance sheet, the income statement, the statement of owner's equity, and the statement of cash flows. Each has their own equation. The balance sheet is your assets equal your liabilities plus your stockholders' equity. We said your assets are things you own. They include receivables. Liabilities are things you owe, right? They include payables. And then stockholders' equity includes like a common stock and retained earnings portion. Next, we said your income statement, it's your revenues minus your expenses equals your net income. Your revenues are your sales from your products or services. Your expenses are basically the associated costs or resources used to generate that revenue. One thing I do want to mention here, if you're looking at the homework, dividends are not an expense. So if you declare and pay a dividend, that's not an expense. That actually goes on the statement of owner's equity under the retained earnings portion. Dividends are a reduction of retained earnings. They're not an expense. The third idea here is the statement of cash flows. It's your beginning cash plus your inflows minus your outflows equals your ending cash. And with regard to those inflows and outflows, you have to categorize them into one of the 3 categories: the operating, the investing, the financing. And then finally, you have your statement of owner's equity, where it has the common stock portion, beginning common stock, plus what you sold, minus what you bought back, gives you your ending. And then it has the retained earnings portion, your beginning retained earnings, plus your net income, or minus a net loss, if it was a net loss, minus your dividends, that's where dividends go, equals your ending retained earnings. So I'm going to stop there for this lecture.